strategist. Jack Janasiewicz, he's got $49 billion in assets under management. Perspective, we like to do that. The S&P is just under 1% from its record high that was struck earlier this month. So looking at the entire picture, not just today or yesterday, where we saw the bulls really moving quickly, what gives you the sense that this is a market that continues to move higher or not?
You know, it's all about the earnings backdrop. And I think when we start to look at the earnings, it's up and to the right. And I don't think you can really argue against that for really supporting the equity markets going forward. We're seeing very little contribution coming from earnings expansion, from multiple expansion. So really what we're seeing is a complete driven market coming from earnings growth. And that, I think, is very important here. And we don't really see any signs of it really rolling over. Maybe it slows a little bit, which means we slow the appreciation of the markets in general, but it's not rolling over.
Yeah, when you look at the S&P Max chart, that's where you see how close we are to the record high. And I think that's important to put into perspective because people have made a lot of money if they were long equities over the past year. Should they continue to be long equities?
Yeah, I think that's the right trade, but I don't think you can expect it to continue to move up in a pretty linear fashion. You're going to have some chop in there. There's going to be some concerns in there with regard to maybe some of the unwinds that we're seeing, some crowded trades that we're seeing, especially today, what we saw last Thursday, so that AI trade can bounce around a little bit. But I think in general, when you zoom back out to the bigger picture backdrop, it's still very supportive. And I think the odds of a recession, in our view, still pretty low.
Okay, and yet you are a little bit more cautious. What red flags do you see?
Yeah, I think there's a little bit of a list here. You know, and first of all, the market right now is really driven by the AI trade. And we're starting to see a little bit of broadening out, but it's AI all the time. And that's the thing we're going to be paying attention to as we head into second quarter earnings season. We want to hear about CapEx and OpEx. You know, are we going to continue to see the CapEx spend manifest with the hyperscalers? Are we going to start to continue to see the OpEx spend from the token usage? Those things are going to be very important. That's all really manifesting in the earnings backdrop.
Housing market in stasis. Non-AI economy, you say, is tepid. And then the tax refunds. You say they were more saved than spent.
Yeah, and that comes back to that consumer backdrop, right? That K-shaped economy really starts to come in vogue here. And what are we seeing with regard to some of the sentiment surveys that we've read? You know, the consumer really necessarily didn't spend it all. They actually spent a little bit of it, and some of it was used to pay down debt, and some of it was used to save. And so I think that multiplier effect that a lot of people were banking on to maybe push us closer to 3% real GDP growth, maybe we got a little bit extended on that front. It's not quite that aggressive.
Dow Jones Industrials right now at down about 193 points. And the weakness in chips that we are seeing today, all because Samsung's great wasn't great enough. Mm-hmm. I mean, is this how it's going to go? Yesterday we're up triple digits. Today we're down triple digits in the NASDAQ.
Yeah, I think there's a little bit of a technical backdrop to consider in here, and that really comes back to crowded trade positioning, right? We think about things like the correlation trade, the dispersion trade, all are basically at record tights. We look at the momentum factor, the beta factor, all at record highs in terms of decile performance. That to us indicates a very, very crowded trade, and it goes back to that AI backdrop. Really, everybody's piling into that same theme. So when you get a little bit of a hiccup, it's not surprising you're going to get some unwind, and that's what I think you're seeing right now.
You know, we are expected tomorrow to get consumer credit for the most recent print. Are people extending themselves too much? You point out wage growth is not keeping pace with either the Fed funds rate at the moment, nor the PCE headline number. That's the Fed's inflation preferred gauge. Actually, they like the core, which eliminates the often volatile food and energy. But at the top level, we have that at about can we put up the graphic? May PCE was 4.1%. Current Fed funds rate, 3.6%. June wage growth, 3.5%.
So I think there's two takeaways there. You know, one, when wages are growing at a pace lower than what the Fed funds rate is, to us that implies maybe the markets actually, or the financial conditions are a little bit tight. The second one, wage growth really has to keep up with inflation. Otherwise, you're getting a negative effect there. And I don't see how you can continue to see consumption grow at that same pace when you just can't keep up with the rate of inflation.
Amazon announcing it's going to do a $25 billion bond sale because it wants to raise more money to spend more on the AI build-out. You excited by that? You thinking it's a little bit too much?
I think it's good because we just talked about the AI trade all the time, right? And that's going to be one of those CapEx numbers that we're continuing to pay attention to. So as long as we continue to see those hyperscalers and whatnot continuing to actually put numbers forward for increased CapEx, I think that's a pretty good sign for the market that this will at least continue in the near term.
Yeah, let me just look at Amazon because earlier it was not getting hurt. We do have it up about 2/3%. $1.61 higher to 245.
Good sign that the market's not imposing capital discipline here. They're okay with that kind of stuff. So I think that's another good sign going forward.
I always listen to NYU professor Scott Galloway. He is just doubling down on Amazon. He says that is the stock. He picked it at the beginning of the year, said it would be a great performer.
It's in a pretty good situation, I think, to take advantage of all this.
What else do you like outside of tech?
You know, we're talking to our clients and saying maybe a little bit of balance in here, and that really falls back to cyclical value. And it's the idea that, you know, if we do get a little bit of nervousness in this AI trade, we get a little bit of an unwind, you want to actually still be invested because this is a rotational market. Hard to see people actually selling and moving to cash. Our idea is that you just sell and move to a different part of the market, and maybe we start to see a broadening out, whether that be in healthcare, whether that be in financials, to a lesser extent industrials.
Biotech healthcare you like. I mean, you said after a period of consolidation, it's again breaking out. I keep hearing this, and yet then it's sort of in fits and starts.
Yeah, and I think part of that, one is it's supported by the AI backdrop, but I think the other side is when rates start to push higher, it acts as a headwind for that sector. So, you know, I think if you get the combination of potentially lower rates as well as the AI trade sort of manifesting in the biotech space, that actually will be the catalyst for us going forward.
I found your perspective, which I read in depth overnight. I just feel that it's really important to point out what you pointed out, and that is there are some headwinds that are picking up the speed, and it's important to note that wage growth is not keeping pace at the moment. So it's just important to note, and that's why you got to listen to people like Jack Janasiewicz.